Get started now. I have Gerald Stewart, our local HUD consultant, on the call with us today, along with my assistant, Brooke Highline. We'll be discussing our renovation programs. And I'll start out with our conventional renovation program. This is called our Fannie Mae HomeStyle program, and we also have something called Freddie Mac Choice. They're conventional renovation programs with a couple different down payment requirements. We just talk about the one because I'll fit the needs to whatever the client, will need on their property. So the funds for the down payment and closing costs can be gifted for this program. We do have a minimum credit score when you Google or research things online that will say 620. But what happens with these programs is that it's a whole profile that they take into looking at whether you'll be approved, and it's called Desktop Underwriter that runs it. We're seeing a lot of issues if a credit score is below 680 getting these through. So basically, while you can Google, and that's great, and knowledge is power, of course, sometimes people will be like, but yeah, I Googled it and it says I can, my credit's fine, but it won't go through the system. So, obviously there's going to be things that impact decisions for, credit profile, down payment. So we run each file through our system, and typically they're going to be looking for a 680 score, which is why I have that asterisk there. The borrower does need to occupy the residence for a minimum of 1 year after the work is done. So the clock does not start ticking when you close, it starts when you move in for your residency, because this program is for primary residents, and you do live there for a year. We do have investment properties are allowed, but only 1 unit. So I'll get to that in a minute. But if you are saying this is your primary residence, you do need to live in the property for a year after the work is complete. As I just mentioned, the desktop underwriter determines the eligibility of the client, the reserves required for the property, and any other properties if a client owns any other properties. So if you're qualifying with like a pending sale, like let's say you live in a home right now and you're going to buy a rehab that's going to take 6-7 months because you're doing a gut rehab, you do need to have enough funds to make the payment on the current property. We can try to roll in payments on the new property. So I'll work with each client individually if we have that case. Also, you can use a non-occupant co-borrower to qualify. If your income isn't sufficient and you would like a parent or friend or family member to co-sign, that is allowed. Also on these programs, there is not a self-sufficiency test. Why I bring that up is because there is another program that we're going to discuss called FHA 203K, and that does have the self-sufficiency requirement. For the conventional program, they will take 10% of whatever the cost of the work is and put that as a required contingency. And any leftover reserve that's not used can be applied to principal reduction or used for additional work. So if you're doing a job, let's say gut rehab of $150,000, there's going to be an additional $15,000 held for cost overruns. Also, we can roll up to 6 months of mortgage payments into the loan if the property is uninhabitable. And the most important factor is that the appraised value supports these finance mortgage payments. So simplistically, if you buy a house for $300 and you're doing work for $100 and you can't live in it for 6 months, if my appraised value only shows $400,000, then I'm not going to be able to roll in any payments. But let's say the appraised value comes in at $415. Now I have $15,000 to work with to be able to roll in mortgage payments. Why I mention this is I do often get clients who read, some of this information or talk to their realtor and they're like, oh, I was told it's automatic. It's not automatic, but it can be done if certain factors, are in play and line up to do it. So our next program that we're going to discuss a little bit is our 203K. This is an FHA government-backed program. This allows for funds and down payment to be gifted, as well as closing costs. And the seller is allowed to do a 6% closing cost credit if you need it to the buyer. So this has a little bit more allowances in terms of credits, but typically the loan limits are so much higher on conventional, we are doing a little bit more on the conventional side. They did just increase all loan limits, which I'll get into on our next slide once that pops up. but the loan limits finally jumped up significantly, obviously due to the rising prices in every market. So the credit score on the 203K, this can go down to 620. And in addition, we'll do case by case down to 580. But there are a lot of overlays if we have credit scores under 620. So it's definitely a little bit tougher. But credit scores over 620, just follow our standard FHA guidelines. Non-occupant co-borrowers, such as a parent or family member, can be added to help qualify. This differs from our conventional because the conventional program is anyone. It can be a friend, it can be, basically anybody. But at FHA 203K, it has to be a family member or someone defined as close to you. Like if it is like a godparent who's not, related to you by blood, but there's a relation of, 40 years as a godparent, they could be a gifter. So there's just some things we'd have to do on that. But that's a great opportunity. I've had people, get a gift for the down payment, get a closing cost credit from the seller, and basically go into a property without a lot of their own funds, which is really nice. You can also have on single family, the non-occupant co-borrower, if they do want to be involved, it's a 3.5% down payment. If you have a non-occupant co-borrower, though, on any multi-unit, regardless if it's my program, meaning a 203K or just a regular FHA move-in ready, this is an FHA guideline. If you have someone who's not occupying the property and you're buying a multi-unit, they increase the down payment to 25%. Most of my clients qualify without a non-occupant co-borrower, and FHA has the lowest down payment for multi-units. It's 3.5% if you qualify on your own. The only reason I kind of bring up this non-occupant co-borrower is probably on 30% of my files I have that, and when they're trying to go into multi-units, it can be a little bit shocking that the down payment's higher, so I just bring it up here. We can do any of these programs on refinance or purchase, and if we are doing a refinance for FHA, we may need 2 appraisals. It's going to depend on the cash to close that the buyer wants to bring. The primary borrower has to occupy the property for a minimum of a year, same as our conventional program. And the 3 to 4 unit property has what's called the self-sufficiency test. What this means is the market rents of the property based on all the improvements. I add them all up for every single unit. I know you're going to live in one, but I got to add them all up, and I have to multiply by 75%. That figure has to be greater than the mortgage payment for FHA to approve the loan. So the rents are really critical, and we do get a little bit stuck on higher priced properties. If we're at like the limit, typically, sometimes if the rent doesn't support it, we can bump into this self-sufficiency test. If it doesn't pass, there's no exception. We'll get an exception. There is none. It's a hard stop. It's black and white with FHA. It passes or it doesn't. So again, if anyone's buying a 3 to 4 unit, I will walk you through it. We'll get with your realtor to make sure that it will pass that test before you even make an offer. 3 to 4 unit property, borrowers have to have 3 months of their own funds for principal, interest, taxes, and insurance. That is a requirement, no exceptions. And people are like, well, I'll get a gift for that. That's not allowed either. So as long as you have 3 months of reserves on a 3 and 4 unit, you're fine. And it could even be in a 401k. So that's just something we watch out for. And that those market rents, which I discussed, are going to be critical to the self-sufficiency test. So for both programs too, what's great now is that they allow material draws after we close. Once permits are obtained, they will pay typically the vendors direct when the GC is ordering, materials to give them some upfront money. So for FHA, they'll do anything for like windows, flooring, kitchen cabinets, roofing, and the consultant will write that into the first draw and work with your GC to get that sent out. For our HomeStyle, they'll do 50%, I believe up to $50,000 on the first material draw. So it's a little bit more money, and our consultant will speak on that in a little bit. We'll get that question brought up. So eligible properties are 1 to 4 family properties. So 1 unit, 2 unit, 3 unit, 4 unit. We can do condos, townhomes. Typically on condos, we're doing that through our conventional program because FHA has a restriction that you can only do up to a 4 unit building. Most of my condos have more than 4 units. So we're going to see most of the condos going through our conventional program. Townhomes are treated as single-family home if they're legally described as that. If they're townhomes, can also be legally described as condos. So we do check the legal description through the attorney or title company. Investment properties are allowed now, only 1-unit properties on our conventional program. And the down payment is typically 20 to 25%. Credit score does have to be strong, typically over 720. And those are for long-term rentals. If an investor wants to buy and hold it long-term, we can help fix up the property. We also can do multi-unit properties, decreasing the number of units. So if you want to take a 2-unit to a single-family home, we can do that. Also, you can take a single-family home and increase it to a 2-unit. As long as the zoning is in place, I can give you the funds to make the home what you want it to be. But that's a key component, is the zoning. A tear down is allowed only on FHA as long as the existing foundation remains in place and you can rebuild. HomeStyle does not allow that. Our Freddie Choice program will allow for probably about 50% of a home to be put back together. So they're not on our conventional programs really going down to foundation. They do want typically the walls and something to be staying in place to do a renovation loan. So 203K has a mixed use program as well. These are for properties that have commercial space along with residential space. The caveat here is that the commercial unit cannot be renovated with our funds. So if the commercial unit is dilapidated or in horrible condition, we can't loan on it. It would have to be brought up to what we consider passable to FHA, which is, all electric is, in place and it's heated, that there's no like holes in the walls. So I do get a lot of people inquiring about it, but some of these commercial units are not where they need to be, so we can't move forward on them. So that's a very important thing if you're going to buy a mixed use with commercial space, that the commercial space has to be in, decent condition, for the FHA program. But on this program, you can do anything to the residences and to the exterior of the property, roofing, windows, etc., to get the building in good condition. Our conventional program only has a 2-unit allowable mixed use where the owner has to occupy the business and the property. So I don't do many of those. I mostly do the FHA mixed use because we can go up to 4 units on that. Ineligible properties are co-ops, not warrantable condos, and 203K homes that have never been completed, we can't take over, or homes completed less than a year. Same for the conventional program. If the home's not been completed, it's hard for us to get that completed. So I just will talk with the clients individually about what they're trying to do and see if we can get it done. Eligible improvements are any improvements that are permanently affixed to the property and add value. That also includes like appliances, even though they're not like drilled into the home. People don't normally take appliances with them. So they do allow for washer, dryer, anything in a kitchen area, things like that. For 203K, no luxury items are allowed. So these are the new loan limits, literally announced yesterday. Very exciting. FHA has not really moved the needle in years. So we jumped up from 378 to 420, which is really nice because the price points are increasing in the past 2 years. There's just been a lack of inventory. And our conforming price jumped from 548 to 647. That is almost $100,000 jump. That's incredible. So these are the current loan limits in Cook County and our surrounding counties. I do have people who attend the webinar in different states. I will, get you your loan limits. They're similar in most states, but there are some high balance states like Massachusetts, New Jersey, New York, California, Hawaii, things like that. And also in some states for FHA, there's lower limits. So it just really is county by county, state by state. So I work on that with each client depending where you're looking to do your renovation loan. But this is great news. Wanted to share that with everybody. And now we'll get a little bit into the loan requirements. For HomeStyle, guaranteed rate will provide a HUD consultant. I'll explain his role a little bit more. It's required for any structural project or any project that has repairs over $50,000. When I say $50,000, that doesn't mean the contractor bid. That means $50,000 inclusive of the contractor bid, any inspections required, permits, the contingency I need, and the architect, things like that. So it's an inclusive amount up to 50,000. I would say on 85 to 90% of all renovation I do, we have a consultant. It just ends up that it's very rare where I'm doing very small projects because people are using the money to get the whole house done and get as much as they can with our money at a low rate. So the contractor and consultant write-up is required along with an architect's floor plan. It is really critical that the first 30 days we get all of this. I can't tell you, I feel like, I think November is a month to not remember. I feel like there's a commercial with something that you should remember November, but November was tough for me because I kept getting people like, I got this, I got my contractor, we're all good, we're rushing to get this to close. And my 30-day timeline comes up and they're like, oh, the guy I had said he can't do it. I'm calling people. And now we're at week 6 and I'm still not, I don't have what I need. And then they're like, okay, I'm going to have it today. We need to close next week. That just doesn't work. I mean, there are certain requirements we need, and I can't stress the first 30 days how critical it is to make sure that everybody is lining up and that you get a, maybe if you think someone's going to be your GC, always have a backup just in case, because it seems to be like where we're running into problems are people think they have a GC lined up, and then when it comes down to it and getting the paperwork, they're giving them excuses or, I can't do it, or I'm 9 months out. So just make sure you talk with me. If you need help with GCs, we can try to figure out, areas to send you to. I don't refer them, but there's ways to find GCs. We try to help you with that. And again, I'm going to go about the architect issue. We don't get the architect on day one. We get the consultant report. We get him out, and that takes about a week to get back. Then we see if it's even feasible to do this. I'd say 20 to 30% of all of our files die after that report because now we have really pen and paper with real numbers. We're not HGTV. We don't have like big networks and big banks behind us, and all these, advertising companies. We're in a real, situation where costs are up a bit and you're going to get to see if it makes sense to do it. Let's say it comes in and it's good and it's what we think. Now you're telling me, hey, we are doing an addition. Well, now I need an architect floor plan. So what I like to do is typically I tell people doing like any change to the floor plan, get an architect scheduled for about 10 days out, okay? Because the consultant report will come back, and if we need to cancel that appointment for any reason, at least it's scheduled properly to maintain our time frame. So the floor plan's critical, the architect timing, the consultant timing, and obviously getting the GC bid. Work has to be started in 30 days and no lapses. Then what that means is 30 days from the time we close, that's when you start to get the permits. Now, permits can take, 30, 60 days. So it's not like work's going to start on day one. You got to get the permits, then you got to get materials and money and things like that. So just the first 30 days is focusing on getting the permits and getting the architect plans filed with the, each municipality to make sure you can get your permits done. Work should be completed within 6 months. However, there are month-to-month extensions up to 12 months. So people do get stuck on that 6-month thing going, how am I going to get a full home rehab? Like I'm doing an addition and everything. My contractor said that part's 6 months. It's going to take 2 or 3 months for permits. We understand that'll be extensions for 30 days and you'll be fine. Also, all loans must pass the high cost test. Why I bring that up is I'll have a lot of people go, well, I want to buy a house for 30 grand and fix it up for 20 and it's going to be worth, 100 and I'm, starting my little nest egg of properties. But we can't pass what these tests are for closing costs and fees that are not even related to us on very small purchase prices. It just doesn't work. So we do that. We do advise people that, if it's a super low loan amount, we may struggle to get it through the system. And if we can't move forward. Also on both programs, self-help is allowed if the borrower is a licensed GC. For HomeStyle, the family member can also be a GC. So if you're in the trades or you are licensed or you have a family member on HomeStyle, that is allowed. The caveat on 203K quickly, there is a slight difference. Family member cannot be a GC on our 203K. It's considered a conflict of interest and identity interest. So that's just one thing to remember. I'll talk a little bit about 203K program. The HUD consultant is required on this program for any project if they're structural. That's for either project. Any program that has structural, a consultant's required regardless of the amount of the work. But for 203K, it's a lower amount too. If it's not structural, we need them for anything over 35,000. And again, that's including all those fees I talk about. Like you got to pay permits. You might have to have like inspection fees. So we will tell you whether or not you need a consultant. Self-help is allowed, as I stated. Family member cannot be the GC, as I discussed. Tenant cannot buy from a landlord on our 203K program. I get this a lot. It is just not allowed on a 203K. It is allowed on a regular FHA purchase, but not on a 203K. A realtor can be a blood relative to the borrower and give their commission to aid the borrower in purchasing the property. And also a family member can buy from a family member. It's 3.5% down if the family member buying the home or the family member selling the home has resided in the home for the past 6 months. If that has not happened, then it's actually 15% down required. Okay. If someone's saying they're buying from a family member, my first thing is to try to figure out who's living there so I can talk about the required down payment. So we talked about all of that. Let me get to the next slide here. Hold on, I think I skipped one. Okay, here's the role of a consultant. The consultant is a specialist that is approved with HUD to come out to the property to do a write-up. They detail the cost, broken down material and labor, and they remain involved in the process from the beginning until the end, because not only are they involved now up front, they're going to be working with you to pay your contractor out. They're going to be doing the inspections to make sure the work is done. Okay, so they'll give you a write-up and show you all the costs and what permits, and they do estimates, which is great. We get that report back about a week after they come out. So they come out and visit with you at the site, walk through what you want to do. You pay the consultant at the time of the appointment. It is not refundable. It is able to be financed into the loan, and I can give it back to you at closing. But if you do not close, that's just a payment that's made for a service that's performed, no different than a home inspector. We always start with the consultant, and if you choose to do a home inspector, we ask you to typically do it after you get the consultant report to make sure that you're going to move forward, so you're not double paying. The specification of repair will include for 203K any mandatory repairs. It also includes recommended repairs and desired repairs. The consultant will deliver the report to myself and you, the borrower, and then we discuss if it looks good, if there's any changes that we can be made. And look, a lot of people get the consultant out there, they get excited, they start adding more work they didn't think they were going to do, and then they get this big write-up. Don't panic, you know, as Gerald will sometimes say, sit down before you open it and then let's talk, because typically people are asking for more than they ever wanted. They just kind of want to know the price. So a lot of times we're scaling back or we're figuring out better ways to make it work. So we do try very hard to keep, you know, this going. So once we get moving, let's say the loan closes, the repair funds are placed in an escrow, and then the GC gets permits, provides the permits to us, and can start getting material draws. Then as work is performed, the consultant's involved going out, taking photos, and getting draws 1, 2, 3, 4, and 5. So we have 5 total draws that we pay out to the GC. Here's the consultant fee schedule. This is paid at the time he comes out. It's all based on the estimate of work. So if you call and say, hey, I'm doing, you know, kitchen, roof, flooring, couple bathrooms, it's $55,000, that's my guess, then I'll let you know you're probably gonna be paying $800 at the time of the appointment, and it's right here on the schedule. So it's pretty clear and it's not made up. You know, this is just the schedule. On HomeStyle, which is our conventional program, the fee schedule goes 1% up to $200,000. So if you're doing an addition for $200,000, you'll be paying $2,000 for the consultant report. Then it goes in lump sums. $200,000 to $300,000 is $2,500. Anything greater than $300,000 is capped at $3,500. The draw inspections, which pay your contractor, are always financed into the loan. And again, any money you pay the consultant at the time can be financed into the loan, and we can then reduce what you owe at closing. Contractors, the borrower selects their contractor. 50% of some of the funds are upfront, you know, available. 203K is a little bit more restrictive with only 4 or 5 major categories that they'll pay out. Contractor has a sign-up package that they need to fill out, which is their their profile. Basically, we ask for like referrals, their insurance, how long they've been in business. We check to see that they're not changing their name a lot, because that can be kind of a red flag. You know, there's certain things that we do behind the scenes to try to make sure that there's nothing unusual about your contractor that could cause any issues for you. So this is a nice protective measure for the clients, because you probably would never know to do some of the stuff that we're going to do, and you know, we'll get that done for you. If there's lead-based paint in the home or mold or asbestos present, we would need someone who is certified in that to remove it. So your GC would either have the certification or their subcontractor. Typically, these loans take 60 days to close. Let me go back to here. So when people say they want to do this, they're not the quickest closings in the world. They take about 60 days, because we're getting that first 30-day, the information I need to order the appraisal. Rates are definitely about 0.5% higher. There's been a bigger spread in the rates lately, just due to the risk of construction. And again, if you have any layout changes to the home, any floor plan change, you know, closet turning into a bathroom, bedrooms being combined or maybe split, we need floor plans so that the appraiser can accurately give a value, okay? And we do offer jumbo and new construction. I don't have anyone on the call today interested in that, so we're going to skip over that. VA renovation, we also offer, but renovations are only cosmetic and can't exceed $50,000. So that's a little bit about our programs. I am going to introduce Gerald Stewart. Gerald,